All right. Matt, the mortgage guy. In today's video, I am talking to real estate investors. I want to talk to you about real estate for the long game, how to build long-term wealth, how you should be thinking about real estate and trying to hit base hits, not home runs, especially in today's market. Stay tuned. Towards the very end, I'm going to help you decipher what type of investor you are. Are you trying to build wealth? Or are you trying to replace income and chase cash flow? Two different kinds of investors. You need to know who you are. You need to know what your North Star and your goal is in order to drive your decisions when it comes to real estate investing. All right, Matt, the mortgage guy, residential mortgage broker, real estate investor. In this video, I'm going to talk about something that's on my mind when it comes to real estate investing because I talk to real estate investors every single day. My wife and I are real estate investors ourselves, so I know what goes into the thought process behind real estate investing, the goals in real estate investing, and truth be told, different people have different goals. So they need to set different objectives and go looking for different things. In this video, I'm going to clear up some misconceptions about real estate. Some people think that you're just going to plug in, you're going to get cash flow, you're going to get appreciation, you get all the things. Not the case, especially in this market. Though you can, in this market, continue to buy real estate deals that are going to help you build your wealth long term. Let's talk about it in this video. Before I get started, quickly, greatmortgagebroker.com, fill out the form. Connect with me and my team if you want to get pre-approved and start writing offers on real estate deals. Go to homeandmoney.com/Matt if you want to connect with an agent in your area anywhere across the nation. Okay, with that out of the way, I want to go through a quick little exercise just to show the numbers behind it and be straightforward and honest with folks. If you're buying a real estate investment property in 2022 or 2023, you can't have your cake and you can't eat it too. Too often, I get investors who have either hit a home run in the past or they've talked to people who have hit home runs in the past, and they think that that's a normal occurrence. You're going to buy a property that gets you $500 a month in cash flow. It appreciates 15% a year, and it's going to triple in value in the next decade. Not usually the case, and not what you should expect when you're investing in real estate. If you're investing in real estate, you should have a Warren Buffett type approach, especially if you're in residential real estate, single family homes. The same can also be applied to the smaller multifamily. You're trying to get rich slow. You're trying to build net worth over time. You're not trying to buy Bitcoin at 800 and see it go to 60,000. That's not the real estate game for 99.9% of the people that play it, right? So with all of that in mind, let me go over a quick example to show you that you can build a lot of wealth over time. In year one or year two, you might even be in something that is on paper losing money. So you should view real estate as a long-term wealth builder. For a lot of folks, you got to choose if you're in one of two camps. Do you want monthly cash flow, replace the income that you have because you want to retire from a job, or quit a job, or just do real estate investing full time? That's one bucket. Or the another bucket is I want to build wealth over time. I want to take a portion of what I'm earning from my job, invest it in real estate so that 10, 20, 30 years from now, I've got 2 million, 3 million, 5 million, 10 million in real estate assets that are one, paying me monthly cash flow, or two, or maybe even both, I've got significant equity that I can pull out to live on, that I can sell a property or two and live on. Whatever the case may be, there's two different things. There's cash flow and there's wealth accumulation through equity. Those are different things. And I'm going to show you some examples here. So let's first start. Talk to investors all the time that in this market, in Sacramento, where I'm located, they want to buy something and they think that on day one, they're going to get $1,000 a month in cash flow buying a property in a decent neighborhood. Really not going to work. In general, the more risk you take in the worst neighborhoods, the more cash flow you can get, but the more problems you're going to have, the more vacancy you're going to have, issues collecting rent, it's going to appreciate probably less. Whereas you get nicer neighborhoods, nicer schools, higher price points, it's going to appreciate more over time and you're going to build more wealth, but you're going to get less cash flow per month. I want to show you a neighborhood that's a great neighborhood for investment properties that are going to appreciate. It's a great neighborhood for first-time home buyers and people that want to live in these neighborhoods. They're both true, but just from an investment property standpoint, let me run the numbers for you. Property that's a 4-bedroom, 2-bath, rents for about $2,400. In a market like this, you can go out there and maybe offer $420,000 and get the offer accepted. So 420 is the number I plugged in to the investment property analyzer I got here. And all the other stuff fills in. We know that the rental income for this area is $23.94 per month. We take into account all the expenses, including the fact that I think it's something like $175 a month in maintenance. Owning property isn't free. So let's just put it out there, right? All this stuff, year one monthly cash flow is negative $350 a month. This is for someone who's trying to build wealth long term. If you're going to put $500, $1,000, $2,000 into an investment account, into a 401k, into something else, and you can afford to have a property that isn't making money day one, this is a property you can consider buying. If you're living paycheck to paycheck and you put together a down payment, you're going to put it in real estate, this isn't the property for you because I don't want you to stretch and have something going negative, but I'll show you what happens over time. Year one, considering everything, you've got negative cash flow and your cash on cash return is negative 4%. Year two, negative 2.7, negative 1. After 9 years, because we're owning the real estate for the long term, you'll see rental income go up, what you owe on the property go down, while expenses should stay relatively steady. In a property like this, that's a nice property in a nice neighborhood, you shouldn't have a ton of expenses, but you're going to have some. So that number of $175 a month or a couple thousand a year is probably a good number to roll with. So amortization gain, you're paying the property down. Appreciation gain, this is forecasted appreciation based on this specific zip code. And if you wanted to go to historical and say, well, it might not appreciate this much per year, let's go to historical. We can go to historical, right? And then it's going to alter the numbers. But here's the magic: is after 9 years, with rents going up, with the property appreciating, with you paying the mortgage down, you've got a total return on investment after you put down 20%, $84,000 of 331%. Annualized, 17.6%, and then it compounds. That's how it gets up to 330%. It's because 17.6% a year compounded. It's not all sunshine and rainbows in the first couple years, right? You're lucky to break even after 2 years. But if you're holding it long term, 17.6% is a pretty good average return. If you've got your money in Wealthfront, you're getting 2%. If you've got your money in the bank, you're getting 0.1%. What I want to do, because I know that the immediate pushback is going to be, listen, Matt, you don't know if this is going to appreciate 5% year over year. It might be flat in 2023. It might be negative 10%. Fair enough, right? And saying over a 9-year horizon, 5% a year, it could be high, it could be low, it could be either one. So let's just put in a custom appreciation. Let's go down to 2%. Remember, even if we see negative 5% in 2023, negative 5% in 2024, or negative 10%, over time, if you hold it for a long enough time, real estate appreciates. It's just facts, right? I'm not going out on a limb, but let's do 2% custom, which would be well below historical averages, would mean a couple bad years. We put in 2% forecasted appreciation. It's going to make the beginning years even uglier, but not from a cash flow perspective. The cash flow is the same, right? It's not like you're going to be losing more money on a monthly basis. You're just not going to see the appreciation. that you'd see be as much, right? Over time. Over time, this thing's going to be worth, 500 after 9 years, which would be pretty slow growth. Maybe that's what we see, right? It still ends up being 138% return on investment and a 10% average annual compounded return, which in my book, some people like stocks. Some people like putting money in their 401k. Some people like real estate. Real estate happens to have tax benefits. It happens to be an asset that I really like because you can see it. You can drive by it. Your tenants move out. You go in and do some things. It's a real thing that you can touch and you can feel, more so than you can Ethereum or Bitcoin or other investments, right? So if real estate is your thing and you're looking to build wealth over time, this is one property purchased by one person who's, it's going to net 6 figures in the very worst case scenario. If we go back to the historical, we won't even use forecasted, we'll just use historical, that profit's going to be closer to 300 grand over a decade. If you can do this 3, 4, 5 times over a decade, even over 2 decades, as a supplement to your day job, and you can add 1.5 million plus to your net worth, it sets you up in retirement. So I don't want this video to go too long. I just want to show a quick example with some real numbers on a real property, given realistic returns, and it may or may not be for you. If cash flow is your thing, you're probably investing in 2 to 4 units. You're probably investing in cheaper neighborhoods with higher turnover, with other issues, but bigger cash flow numbers if you're able to get consistent tenants in there, minimize your repair costs, and do those other things. I just happen to prefer the long-term wealth building that goes with properties in a little bit nicer neighborhoods. And truth be told, my wife and I have a mix of both. Some stuff in great neighborhoods, some stuff that's multifamily that's not in the greatest of neighborhoods, and they both serve their purpose. But in general, cash flow is, either cheaper markets where you go to a market where you might be able to buy a house for 150 grand in a different state, or in your current state in a C or D neighborhood versus an A or B neighborhood. All kinds of things to consider. Way too much to get into in this video. This was just an overview of how real estate is a slow build, a slow grind, but you should have the long-term perspective. You should be looking to hit base hits. And this base hit that ends up being $278,000 in profit from an $84,000 investment, you only really need 3, 4, 5 of these base hits to change the trajectory of your life, your retirement, your wealth. Hope this was helpful. Thanks for watching. Again, greatmortgagebroker.com. Fill out the form, connect with me and my team. homeandmoney.com/Matt to connect with an agent in your area. Until next time, we gonna see.